Okay, welcome back, everybody. Today is Wednesday. We are still working in chapter three. I do not believe we'll get through it today. Most likely Friday we'll get through chapter three. Is the hopes. Um, so last class on Monday we left off with we were on the constraint hierarchy with the different levels of constraint that is placed on fund balance. Um, we left off with unassigned funds. Anyone have any questions on anything we covered so far on last class? We're good so far. Oops. Gosh, it's almost impossible to pick stuff up in these dress clothes. I hate wearing dress clothes. All right. Anyways, so for just a second, right now, I want to jump back up here to a slide we already reviewed, and just revisit this two-step process one more time. So if you recall, there's a two-step process to labeling these funds, whether they're non-spendable or spendable. First step for the non-spendable resources, we want to identify those funds, resources that are non-spendable. Non-spendable resources are most commonly your inventories and your prepaid items. It says here it can also include assets held for sale and long-term receivables, um, and the principal or the corpus of the permanent funds. We know that is what the non-spendable resources was. Then we move on to step two of the two-step process, and obviously, if it doesn't fall in the non-spendable category, then it falls into the spendable resources. Um, we recall that the spendable resources have four different categories with levels of constraints placed on them, moving from the non we had the non-spendable, and then we had the restricted all the way down to the unassigned, right? So the spendable resources is going to fall in one of those four. So obviously all remaining net resources of a fund after removing those determined to be non-spendable are going to be spendable. As I said, they're going to be furtherly classified. So there's our two-step process. So now I want to jump back up here, and we're actually going to apply give a little example, give an example applying that little two-step process here. So this is if we're actually going through the process of actually building this financial statement here. So step one of classifying whether it's non-spendable or spendable. So let's just see here, and this is all just an example. We're not really pulling any data out. They're just kind of just showing us how it works. So it's just a little overview here. So don't really worry about where the numbers are coming from. We're more concerned about where we're going to place the numbers here. Okay. So we're going to kind of just focus where it's highlighted on the slides. So it says here, are there any assets that are not in spendable form? And they're referring to inventory or prepaids. And are we required to maintain a permanent fund corpus? Well, just for now, in this example, they're saying no, none of that, what we just said within that is relevant. There's no inventory and prepaids, and we're not required to maintain that permanent fund corpus. So obviously that means here for the fund balance, because if you can see here, we have our assets and total, followed by our liabilities. Obviously the difference is the fund balance. So now we're building that fund balance section. If you recall from chapter 2, the fund balance section that we would see underneath this, that's what we're building. So obviously if we don't have any of these non-spendable assets, then there's not going to be anything listed here, and we'll proceed to the spendable categories, right? Okay, so there's first scenario with non-spendable. We didn't have any. Now let's start all over. We're still at the same point. So it said move on to spendable, obviously, if there wasn't any. So now it's asking us the same question again. Are there any assets not in spendable form, inventory or prepaids? And are we required to maintain a permanent fund corpus? Yes, this case we are required to, because there are some non-spendable things. So if we can see here, it shifts over. The supplies inventory right here of 23,741. So obviously we know the supplies inventory is one of those things that we can't use. So it's going to be non-spendable because those inventories are going to be used for that current period. So we know we need to hold on to those. So we're just going to move that directly down within the general fund column, directly down the supplies inventory. And just pay attention here to what column they're in, okay? Because it's in the column general fund up here. So we're going to move it down here to supplies inventory. So we know that out of all this data, the fund balance between the assets and liabilities, that amount is non-spendable because it's restricted to supplies inventory. Let's just assume for the corpus of the permanent fund, assume, as we can see here, that of the permanent fund, we have $25,366 in it. So of that $25,366, $25,000 of it is the corpus or the principal of that fund. So we need to maintain that. That's going to be non-spendable, right? Because remember, the corpus of the permanent fund is non-spendable. So when building this fund balance section, that $25,000 of it is going to be moved down here. See how we're keeping it in line with the permanent fund, but it's non-spendable and it's permanent fund principal. So we know that part of this amount of that fund cannot be touched. So only the $366 can be used for whatever the purposes is, because that's the earnings on it or the interest, right? Makes sense? Okay, so now we've seen an example of where there is no non-spendable funds, so it was just empty and we moved to spendable, and we've seen the other side of it to where there is non-spendable, and we see how we go about actually moving it just directly from where it belongs into where it needs to end up. Does that make sense? Okay, so next step, we're going to move on down. Next, obviously, if it's we're done with the non-spendable section of it, right? So next we want to move on to the spendable funds that we can have, spendable fund balance. So we know out of the spendable part, there's 4 sections, right? And we'll start with the highest constraint with the restricted funds. So here we can see here are restrictions imposed by outside creditors, grants, or imposed by law. Because remember, that's what stipulates it being restricted. It's imposed externally from grantors or debt covenants, whatever it is. So that's why it's asking us that. In this case, yes. We're going to assume the following. We have a bond sinking fund, a federal school lunch grant, and a state highway grant. So do we know what a bond sinking fund is? Are you familiar with what a bond sinking fund is?
We went over it.
Intermediate.
Yeah.
If you don't recall, I'll refresh you.
Exactly.
The name kind of gives it away. So what a bond sinking fund is when a corporation or a government will actually set up a fund with a trustee, and they'll start depositing funds into that account. And what the purpose of it is for is it's to actually call back some of those bonds or buy them back that are outstanding that the government or the corporation has. So pretty much it's just earmarking, saying we are not going to spend these funds because these funds are going to be used to buy back some of our outstanding debt. So it's a bond sinking fund. So pretty much it's like putting in an escrow per se. So pretty much you're just earmarking it all it is. That's just the name of the fund. So that's what a bond sinking fund is. So therefore, the bond sinking fund, now we've already built the restricted section, right? Now we're in the we're in the restrictions. We built the non-spendable, which is above it, but now we're in the restricted. So the bond sinking fund, we have $200,000. So obviously we see that it's in the debt service fund is where it's in the fund balance section is located in the debt service fund. Why? Because it's a bond sinking fund. We're going to use that to pay off debt, right? Or buy back some of our bonds out there. Same thing. So therefore it has to be in the debt service fund. Next, the federal school lunch grant. Well, what column is that we see it in? It's in special revenue fund, right? So that's the special revenue funds. If you recall, that's for specific purposes other than capital projects, right? So that's why the school lunch grant, that's a specific purpose, right? So that's why it's going to be restricted within the category of special revenue funds. And then the highway grant, obviously, highways, we know that's a capital project, so the restriction is going to be placed within the capital projects funds. Pretty simple, right? Straightforward of what it is. And remember, we're just assuming the following. These are made up, arbitrary numbers are just made up, okay? So don't worry about the math here. That's why I said don't worry about where they're deriving the number out of the relevant data up there. We're just making assumptions right now. So, but it was just showing you how it moves and how we build the statement. So we're good there, right? So obviously we move on from restricted. The next is going to be the committed, right? So that's level of constraint in our hierarchy constraint. So in this case, has City Council formally committed funds to specific activities? Well, they're saying yes, they have. And once again, we're making an assumption that it's on construction contracts, school construction funds, and rainy day reserve, okay? And we know the rainy day reserve is like the rainy day funds, right? So let's just start. So obviously, once again, we're in the fund balance section. We're building the committed section now. We just keep on moving down. And like I said, this is assumptions. Don't worry where we're getting these numbers from. So construction contracts, obviously, capital projects. So the construction contracts are going to be marked as committed within the capital projects fund, right? School construction funds, same thing, capital projects. Rainy day funds, where did they say rainy day funds need to be accounted for, if you recall from Monday?
I don't think I wrote that down, but it's in general.
It's in the general fund, right? So what the only stipulation to the rainy day fund was, and they have it here, is that it's committed, right? So obviously, if it's committed, then they have set a certain threshold to where it has to be a certain magnitude and a certain dollar amount before they expend it. Remember to decipher between everyday occurring events. So therefore, they've actually went through and specifically stated what those thresholds are. That's why it's committed there. If it wasn't stated specifically as to what those thresholds were to decipher it from normal occurrences, where would it be?
Unassigned.
Unassigned. In what fund?
In the general.
Why? You're right, but why?
Well, all unassigned funds are in the general.
Right. So see, you're getting it. So good job. So that's right. So it's the same thing. So you're seeing how it's moving here. That's why it's committed in the general fund, because they've stipulated it, right? So now let's move on from there. Now we're going to go to assigned funds, because that's our next level down. So we're just continuing to build this fund balance section. And it says, are there positive residual balances in non-general fund governmental funds? Why are they asking us that? We were just talking about why, because the unassigned only happens in the general fund. So remember, GASB does not permit any positive balances that's not assigned within any of the other four governmental funds. So that's why it's saying, are there positive residual balances in non-general fund governmental funds? So if there is any positive residual balances, what do we have to do? We have to assign them, right? So we're going to go through and assign them. And once again, we're making the assumption. So they're going to assign the school lunch program and special revenue. Capital projects is in the capital projects, obviously. Debt service, and other purposes. We just have it in the permanent fund here. So they're just assigning it within those funds, so they don't have to kick it back to the general fund as unassigned. Step 2C, we're still on assigned funds. So are there specific resources in the general fund? So we were just talking about the other four funds, right? We had to assign them because GASB doesn't permit positive unassigned fund balances. So they assigned them. So the general fund, are there specific resources in the general fund that are intended for identified purposes? Well, we're going to make an assumption again that the government has outstanding encumbrances for the following. And we're going to get into encumbrance accounting here shortly in this lecture. But what GASB says, encumbrances accounted for that are outstanding at the year end, or if they're outstanding at whatever period is that we're reporting, is going to be as assigned. There's any funds that are encumbered are going to be assigned within the fund balance categories. Okay, there's not another section for encumbered funds. So in other words, it's not like assigned, unassigned, encumbered funds. So if the funds are encumbered, they're going to be located in assigned funds. So that's why they're saying the government has outstanding encumbrances for the following: library acquisitions and other capital projects. So what they're going to do is assign those because they're encumbered. So the capital projects, but you notice they're staying within a general fund now because they're assigned within a general fund, because we haven't actually made that capital outlay. We've just encumbered them. So we still got the funds. So the money's still sitting in the general fund. So just for now, just know if it's encumbered, there's not a specific place to put it. It goes to assigned, not an encumbered column, right? And we know that because from chapter 2, we've seen that statement, and there wasn't an encumbered section, right? So just remember, encumbered funds go in assigned in the general fund, okay? Okay, the last one is unassigned, right? So obviously we know all positive unassigned funds are in the general fund, right? They cannot be in any of the other governmental funds, only the general fund. So it says all negative restricted, committed, or assigned net resources are classified as unassigned, okay? Then the remaining net resources of the general fund are classified as unassigned. So obviously, second part of that statement, anything remaining that's positive in the general fund needs to go to unassigned if it's there, right? Why does it say on the top, all negative, restrictive, committed, or assigned net resources are classified as unassigned? What this is saying, remember, GASB does not, I don't know if we've even covered it yet, but GASB does not permit any of the restricted, committed, or assigned funds to be negative. They can't be, because they were supposed to be restricted, committed for that purpose. Because in other words, if they were negative, we've relocated those funds for whatever purpose we wanted to spend them on. So they do not permit any reporting of restricted, committed, or assigned funds as zero balance. And so if that happens, you have to pull those out, pull money out of the assigned. So let's say in the capital projects fund, we have a positive assigned fund balance, right? But then we have the restricted, committed, and the assigned or whatever. So we have to move that assigned fund balance and try to move the positive amount and cover those zeros or the negative amounts. But if we don't have enough, then those negative amounts are transferred to the unassigned in the general fund to pull it out of the negative. Does that make sense? So that's what that's saying there. But for the main part now, let's just say all positive unassigned amounts go to the general fund. But I just wanted to cover the ground of the other scenarios of why that is what it is. But for now, let's remember, all positive unassigned amounts are in the general fund. Okay, so what have we just done? So the classification of the fund balances is now completed. Okay, so what we're seeing here, this is just exactly what we just went through step by step on building the fund balance section of the actual statement. So if we would look at the full financial statement, remember we'd have our assets, deferred outflows, liabilities, deferred inflows, and then we're going to have our fund balance, right? Well, this is what we would see in that fund balance section. And obviously we can see main thing here we're going to look at. So the fund balance we know is the difference between the assets, deferred outflows over liabilities, deferred inflows, gives us fund balance. Within fund balance, we have the different spendable categories. It's either non-spendable or spendable. Within the spendable, we have restricted, committed, assigned, and unassigned. The unassigned has to be in the general fund. All other residual accounts fall into the assigned balances for other four, right? Because they have to assign the funds if they're going to keep them in there. We just have to make sure. So if you see supplies inventory, remember it was $23,747. The permanent fund principal, $25,000. Bond sinking fund, $370 for special revenue, or $200 for debt service. I'm sorry. So verbatims, just what we just did. I'm not going to go back through all of it. So we just built all these, right? You recall the steps we did. So this is just the main. This is what it's going to look like when it's done. The bottom portion of it. The main thing is just make sure you earmark that you place the funds in the relative fund that they belong. What the constraint on the fund that it belongs. That's the main thing, right? So we can see the total fund balance is here, obviously, but then it shows where it belongs, right? Of the constraints. So there's the total fund balance, but that shows the level of constraints on what we can do moving forward with those funds. Make sense? So there's a two-step process applied. Next, GASB fund balances and encumbrances. So encumbrances. So under past reporting practices, outstanding encumbrances at year end were reported in governmental funds as budgetary fund balance reserved for encumbrances. Okay, we're going to get into all this. GASB requires that significant encumbrances be disclosed in the notes, along with required disclosures about other commitments. Okay, so encumbered funds means we've made a commitment, a purchase order has been placed. Okay, we're going to get into that. Here, the bottom part of it, it says, however, there is no separate reporting of encumbrances within the fund balance section of the governmental funds balance sheet. So once again, remember, here's the fund balances. We don't see anything that says encumbrances, right? Because encumbered funds belong where?
The unassigned general fund.
On the assigned. Remember, they're assigned general fund. That's why there's not an encumber. So that's what this bullet's talking about there. We're not going to see an encumber because they're going to be assigned in the general fund, right? So what's the interpretation of encumbrances? So pretty much at the very least, the existence of an encumbrance is going to suggest that the government has expended or has an expressed intent to use resources for a particular purpose, and therefore those resources should not be classified as unassigned. So pretty much encumbrance accounting is going to be used for the case of contractual obligations. It can be used for construction contracts, and we know that GASB requires resources obligated to contractual obligations to be classified as committed, right? So remember, construction contracts and contractual obligations have to be committed, right? That's where they're going to be assigned to. So pretty much an encumbrance means that we have an intent to buy something. So let's say me and you decide, hey, we're going to order a new car, right? So we call up the manufacturer, hey, we want to get this new sedan, and we're going to use it as a new police car. So once we make that order, we're going to let's say, all right, well, that's cool. This car is going to cost you $50,000, right? So at that point, we're going to encumber $50,000. So we're going to see the journal entries how that happens. So the reason we're doing that is to keep us from overspending because we're budgeted, right? We're worried about budgets. So that just means pretty much, hey, let's go ahead and just make this entry. 50,000's it's not unassigned. We're gonna have to assign this because we just made this order. So that way we don't want it to look like that money's still sitting there because then we could just spit it up real quick. Then when they deliver that car, we don't have the money to pay for it. So that's why we're going to encumber those funds. So encumber means to pretty much just make a footnote like, okay, we're going to make a little note in these funds that this is encumbered because we're going to use that money. But it's encumbered because it's not a liability because we just placed the order. But the people we placed the order with haven't sent us the goods and fulfilled their side of their obligations. See how the accrual kind of comes into it? So we haven't counted it as a liability yet. We've just encumbered it to keep track of what we placed that order for. Make sense? So once again, negative fund balances dealing with GASB. We've already established that GASB does not permit any reporting of negative fund balances for restricted, committed, or assigned fund balances. Makes sense because if they're restricted, committed, or assigned, then they shouldn't. That money should be there because we've said that's what it's for. So therefore we've said it's for that purpose. We shouldn't be using it for other purposes. So that's why they're saying we can't assign a negative fund balance here for whether it's restricted, committed, or assigned. If this occurs, the government should reduce any assigned fund balances in that fund. Remember how I said they have a positive amount in that fund? They should reduce it by that amount of the negative balances and those other ones that are still negative. And the rationale is obviously if the expenditures exceeded the restricted committed resources, then like I said, those funds have in effect been moved for whatever purpose we wanted them to instead of what they were originally earmarked for. Makes sense? So if a deficit remains once all assigned fund balances are zero, so if we've exhausted our assigned fund balance and say the capital projects fund, now it's zero, and we still have a negative fund balance in the restricted or committed, then the remaining negative amount should be reported as an unassigned fund balance. So we would just pull that negative amount and assign that as unassigned. That way we're not in a zero amount, right? Or negative amount. So just remember, no negative fund balances are allowed to be reported for restricted, committed, and assigned, right? Okay, next, activity accounts. So obviously sources of funds. Where is this money coming from? Other financing sources includes transfers in from other funds, because remember funds like the general fund is going to be your main operational fund. But say we need to make a $100,000 debt payment, then the general fund isn't going to make that payment. They're going to make the transfer to the debt service fund, right? Okay. So that's one of the financing sources. So the transfer is in. So that could be a source for the debt service fund from the general fund. So that's one of the sources. And the proceeds of long-term borrowing. Remember? So it's either a transfer in or you've issued debt. Right? That's the only other financing sources. It could be a transfer from a fund or either you've issued debt. Revenues defined as all other inflows and include taxes, charges for services, and amounts provided by other entities such as state or federal government. So revenues are all other inflows, okay, other than issuing debt or a transfer of a fund, right? So activity accounts still on this, and now we're on uses of funds. So money going out the door now, right? Expenditures. So expenditures, remember, as not expenses. So expenditures are recognized when a liability, okay, is incurred that will be settled with current financial resources in the fund. That's why it's expenditures, because it's all worried about this budget, right? And all funds and what's spendable and what's not. So when we recognize a liability that's going to be settled with those current resources within that fund, that's an expenditure. Okay, so we've expended some of that money that's available. That's why it's an expenditure and not an expense per se. I know it's kind of a confusing subject, but that's what the expenditure is. Expenditures may be for salaries, which is a current expenditure, land, buildings, or equipment, which is going to be a capital outlay. We know that, or for payment of interest and principal on debt, which is a debt service. Transfers out of a fund to other funds are classified as other financing uses. So other financing uses is transfers out, right? And that's pretty easy. Transfers out. Easy for other financing uses. What's other financing sources? What's the two ways we can get that?
Other financing sources are transfers
In
and a long-term debt
being issued. Right. Awesome. What's other financing uses?
Other financing uses.
Mm-hmm. We just covered it.
Right. It's.
Oh, you got it. We just, what's transfer sources is what? What's transfer sources?
The transfers.
Right, coming in and debt proceeds. So if transfer uses, other transferring uses is what? Outflows. It's transfers out. That's it.
Right.
Yeah. Sorry, I'm just messing with you a little. Just kind of just that way. It helps. It does help learn that way. I like doing that a little bit. I'm not picking on you or anything. I'm just it just makes it for a better class, better flow, and I think you'll learn better that way if I'm kind of quizzing you as we go along. So revenues. Let me make sure okay. So. Classification of inflows and outflows. So now we know where the money's coming from, right? The sources and the uses. So the inflows and outflows. So now, how are we going to classify money coming in and going out in these funds? So the revenues, some of the money coming in is going to be classified by source. We've said that again. Remember, if we looked at it, we show the source of which it's coming, taxes or whatever it could be. So where the money came from, taxes, licenses, permits, charges for service, etc. That way, the government can really tell, okay, where's our main revenue streams? What can we count on? Where is our money instead of just saying revenues? So obviously, revenues need to be classified by source because we want to know what sources are our stronger sources and which ones are our weaker sources. And maybe subdivided further, such as by the type of the tax, sometimes shown in a separate schedule. So it could break it down from property taxes or sales taxes, whatever it might be. Expenditures and encumbrances may be classified by function. So what function are we using it for? What program? Is it like a school program? Any type of program? It could be a hunger program for the hunger. What department? Is it a fire department, the police department, a health department? What activity? Is it for a park? Are we going to have a parade or something? Character. That's going to be if it's a current or something like that, capital. Or object, where are we buying something? We're buying a car or something like that. So expenditures and encumbrances are going to be classified by one of those things. Makes sense, right? Money coming in, we want to know what source it's coming from. Money going out, we want to know pretty much what are we using it on, functions, programs. So pretty much we want to know where money's coming from and we want to know what we're spending it on too. Makes sense why the inflows and outflows are labeled like that? So outflow classification. So remember character. So if the character is going to be the classification, then it's always either going to be current, capital outlay, or debt service. And we know what those are, right? For current, it's going to be further classified by function. So if we're spending something on something current, so obviously we're spending on some type of a function, right? Because we know if it's a capital outlay, we already know we're paying for roads, bridges, or buildings, or whatever it might be, sidewalks. Debt service, we already know we're paying interest and principal on outstanding long-term debt. So for current, it has to be by function, right? So therefore, is it going to be for the general governments? Is it public safety, streets and highways? So what function are we currently spending this money on, pretty much? See the little trend here? We just really want to keep up with our sources, where it's coming in, where it's going out. It's really particular on those sources. So public safety could be subdivided by department. police and fire. So you could have each division there. Police could be subdivided further by activity, traffic or drug enforcement. Activities in the traffic area could be divided into objects of expenditure. Policemen's salaries as opposed to gas for automobiles. See how I'm saying? You can just keep breaking it down. They can break down anything pretty much. But that way you could really keep track of what's being spent on and everything from the government. Makes sense on the outflow classifications? So budgetary accounting. GASB standards require governments to present a comparison of budgeted and actual results for the general fund and special revenue funds with legally adopted budgets. So remember, general fund and major special revenue funds that have legally adopted budgets. Okay, so that's where we have to have that schedule. Remember the schedule we seen from chapter 2, and it showed the first budget, the revised budget compared with the actual expenditure, and then you have the optional variance column. So that's what we're talking about there. And those are for what funds?
General and special revenue.
Right. Yep. And that's if they have a legally adopted budget. While GASB standards guide the format of this comparison, the GASB does not prescribe budgetary accounting practices and does not require governments to maintain budgetary accounts. Okay. And this is so because budgetary accounts is not displayed or shown in any of the financial statements. It's kind of more of an internal tool for governments to use and to help them maintain budgets. Okay, so the budgetary accounts is not, and budgetary ledgers is not going to show up anywhere within the financial statements. Okay, so that's important to know. But they do require you to maintain the budget. So recording budgets. So although budgetary accounts do not appear in the general purpose financial statements, as I just said, so they're not, you have your own separate ledger. You have a ledger that you do to make your entries for your budgetary accounts, and then you have a separate ledger, a GL, for the financial statements, in which obviously if you make entries in that, it would be reflected into the statements, right? So governments typically record budgets, and governmental accounting systems are designed to ensure compliance with the governments, or with the budgets. I'm sorry. So they have separate ledgers there, right? So one for the budget, one for the GL. So what are some of the budgetary accounts? Revenues to be raised pursuant to law during a budgeted period are set forth in an estimated revenues budget. Okay, so estimated revenues when we're setting the budget, and that's revenues to be raised pursuant to law during a period, whatever the budgeted period is, a fiscal period usually. An appropriation is, when enacted into law, is the legal authorization for the government to incur liabilities for purposes specified in the appropriation statute or ordinance. So pretty much the appropriations are the governmental body gets together and it says, okay, well, we're going to incur liabilities for these certain things right here, and that gives them law, or gives them by law they can actually appropriate funds for those things. So they're going to pretty much earmark funds set aside for those purposes, right? So that's what the appropriations is. Estimated other financing sources and estimated other financing uses. We went into what those are. These are budgetary accounts reflecting anticipated inflows and outflows of resources from sources other than revenues and expenditures. And remember, we already discussed what the other financing sources and other financing uses are. Other financing uses is transfers out of funds, right? Other financing sources is what?
Transfers in and issuing long-term debt.
Right. So those are what the estimated other financing and sources and uses are, okay? So we know what those are. So we have our estimated revenues, appropriations, and estimated other financing sources and uses, right? Those are going to be the main things with the budgetary accounts. And then also the encumbrances. Those are going to be the budgetary accounts. So like I said, encumbrances is when a purchase order or a contract is issued as authorized by an appropriation. The government recognizes this commitment as an encumbrance. So within that budget, if they have appropriated funds for a certain thing, let's say that they appropriated funds for us to purchase new police vehicles, right? So like I said, when we place that order for that, when we get on the phone and place that order, or order on the internet, however you order it, we encumber those funds. because we know that there's an outstanding purchase order for it, so we don't want to overspend. So an encumbrance is not a liability, like I said, since the goods have not been received or the services, but we've just merely placed an order. So it's encumbered and it's not a liability. So at that point, we really have just placed an order, but we don't have an actual liability yet because we don't have the goods. More on encumbrances. Commitments are reflected in the budgetary accounts through the recording of encumbrances and the corresponding budgetary fund balance reserved for encumbrances, okay? And so what this means, we're going to get an example here. Here's the expenditure cycle right here, okay? So the very top of this thing shows what activity is happening, right? And then the second line here, second part of it in the middle, if you notice it says journal entries, budgetary accounts. And then the last part, journal entries, financial statement accounts. Remember how I said there's two journals? One journal for budgetary accounts, which will not be reflective in the government financial statements, and then a whole other set of books, which is the journal entries for the GL, which is for the financial statement accounts. So the entries made there are going to be reflective and ultimately appear in the financial statements, right? So let's start. This is the expenditure cycle. So let's just start with the expenditure cycle. It starts with the city council approving the fiscal year budget for the general fund. Okay, so when they approve the budgets, it's going to be set in the general fund because that's the main operational activity fund for the general purpose fund, right? So that's where it's going to be for us for the general fund. So when they approve the fiscal year budget, the journal entry for that is going to be a debit for estimated revenues, right? Because we're going to assume that's what we're estimating is going to come in as estimated revenues. It's going to be a debit to to estimated other financing sources. So we have what revenues we think we're going to come in, which is from taxes and stuff of that sort, right? Forfeitures and fines, stuff of that sort. Estimated other financing sources. So that's pretty much everything we think we're going to bring in, right? From revenues and other financing sources. So that's everything. They're both debited, right? Then we're going to credit appropriations, which is what the government expects to spend and or incur liabilities on, right? Plus estimated other financing uses, which is a credit, right? And then your plug, which is going to be your plug number, is going to be your budgetary fund balance. Okay, and that right there is how the balance is expected to change from that being set with that budget. So pretty much estimated revenues, estimated other financing sources are going to be debited. That's what we expect to bring in. So let's just say we think that's going to be $100,000. Then let's say appropriations and estimated other financing uses are going to be credited, right? Let's just say that's going to be $50,000. So then the budgetary fund balance is going to be a credit of $50,000, right? Which is a good thing, right? Because why?
Because that's what you have to spend.
That's what the difference is between what we thought we brought in and what we actually are going to expel or spend or put out the door, right? Because that's the difference. Because debits have to equal credits, right? So if we debited more, meaning we brought in more revenues, brought in more other financing uses or sources, more so than what we appropriated or what we expect for other financing uses, then that we have to obviously plug that credit as the budgetary fund balance to balance the equation, your debits and credits, right? So that's a good thing. That means that we're in the plus there. So obviously, if we're going to have more appropriations and more estimated other financing uses than we do estimated revenues or estimated other financing sources, then it would be a debit fund balance, which is less common, meaning it's in a bad situation. We're spending more than what we expect to bring in, right? So that's what the journal entries for the budgetary accounts is going to be right there. Notice there's no entry for financial statement accounts. Next, city department issues purchase orders for goods and services. The entry right here, this is where we get into the encumbrance of it. So we've ordered that vehicle, right? Let's say that $50,000 car we're talking about. So at that point, we're going to debit encumbrances control. That's our debit, right? For $50,000. Then we're going to credit budgetary fund balance. That's this, but we're debiting budgetary fund balance reserved for encumbrances. Is going to be our credit to that debit, okay? And pretty much what that means is we've encumbered this. but then we know that's tied up in the fund balance reserve for encumbrances. So that we just put a reserve. Same thing, depreciation expense, reserve for accumulate depreciation. You know what I mean? That's your debit is your depreciation expense going to what you're familiar with your business sector. Debit depreciation expense for hitting your income statement. Credit your accumulated depreciation. So it's the same thing. Debit encumbrance, credit reserve for encumbrances outstanding to keep it in line because you have to have a credit for every debit, right? So that's how we keep it intact. So that's when we ordered it, right? Now the goods and services are received and invoices are presented for payment. But notice here, let me backtrack. Notice there's no entry when we encumbered the funds in the financial statement ledger, right? Only budgetary because we're keeping up with the budget. This is internally. So goods and services are now received, right? So now all we're going to do is reverse the original encumber. So now we're going to debit budgetary fund balance reserve for encumbrances and credit encumbrances control because it's the complete opposite now. So now we've unencumbered those funds, right? Why did we unencumber them? We don't need to have that encumbered because now we have a liability, right? So now we unencumber the funds as the first step because we've actually received the goods and services. So now we have a liability, so we have to account for it. So now this is going to hit the journal entries that are going to have the financial statements ledger. So now we debit expenditures because now we've actually incurred an expenditure, a current, and credit accounts payable to record liability. Makes sense? So that's the cycle of how we go. And obviously, once we pay for it, debit accounts payable, credit cash. So this. I got to get out of here a little early today, so we're going to stop here. Everything making sense so far?
Yes.
Okay. And Friday we should probably finish up this chapter. So I thank you for your time. Sorry I got to get out here a little early.